So Jeff, you've been in the investing space for a decade now, and in the last 24 months or so, there's been a dramatic rise in algorithmic trading softwares coming to the market. How do you see that fitting into the everyday portfolio?
Yeah, so a lot of people glamorize algorithmic trading and they think that, oh, because this is doing 3% a month or 5% a month, that it's outperforming everything else that they're doing, like stocks and crypto or whatever they're, investing in. And then they think, oh, I should just put everything into the thing that's performing the best. But what they don't realize is it's still important to have proper allocation in those things because really anytime you're shooting for a higher percentage return, you're taking more risk. So you have to understand that piece. It's all about risk and reward, and it's all about having proper allocation so that you're not taking too much risk with too large of your portfolio, because then you risk, losing your entire or the significant portion of your portfolio, which would take a long time to come back from. So it's always really important to understand your own risk tolerance, your own goals, and then be able to determine, okay, based on those things, here's how I want to allocate myself in my own portfolio, which a lot of people need like a financial advisor to help them do, which we're definitely not. We're just a software provider. And it's important to like actually have self-awareness first and then determine, what type of allocation you would have. So like, for someone that's younger that has a higher degree of income and more time to make things back, maybe they have a larger piece of their portfolio in things like crypto or algorithmic trading. But if someone's in like retirement and they don't have a ton of money that they're sitting on to, live off of, maybe their allocation is a lot less. Maybe it's 1%, maybe it's 3%, maybe it's 5% to something like this, because at the end of the day, it is more of a speculative type of vehicle, but there's ways to control the risk, which, you're well aware of now.
Let's back up a bit. When we talk about allocations in a portfolio, traditionally speaking, what does a standard portfolio consist of?
Yeah, I mean, if you wanted to get super vanilla standard, because
Yeah,
I used to
vanilla.
be in, working for the largest bank in asset management for a couple of years. And what I saw a lot of the times, it's just like a regular, 60-40 portfolio or 70-30 portfolio, which is like 70% equities, 30% bonds. Now with the recent, breakout that gold's had, people are like, hey, and bonds are doing terribly. So more people are starting to allocate towards gold. So maybe it's 5 to 10% in gold, and it's like, 15, 20% in bonds. And then the other part of the portfolio is like 60, 70% equities. Yeah, again, that can vary widely. And then some people, they buy a single family house and they live in it. And that's part of their allocation is like their real estate. So maybe the real estate's 30% of the portfolio. But if you were to ask just very blank statement from a financial advisor, it would be like, 60% equities, it would be 30% bonds and maybe 10% gold. And that's just a liquid portfolio that you could put together that's super easy. You buy an index for gold, so you don't actually have to, like GLD, you don't actually have to hold gold in a safe.
Yep.
Then you buy SPY, the S&P 500, and then maybe you buy like TLT or something, which is like an index for bonds. So that would be like a traditional portfolio.
Would you say that in the last decade or so that people are more aware of alternative assets to put inside of portfolios?
Yeah, I mean, you're just seeing, I mean, even just the Magnificent Seven has held up the entire stock market over the past few years. So people are starting to realize, and like, what are those companies doing? They're very forward-thinking, tech-based companies. So people are starting to focus more on like, okay, what are the things that are really trending and driving innovation? And people are placing more capital into that. So as people see technology, things like AI and stuff advancing, they're starting to consider, alternatives or, having a more direct allocation to a certain like industry or sector. And that's, part of algorithmic trading, quantitative trading. It is like, it's not new. It's actually been around for decades. There's been funds that have been using this since the 80s, but it's becoming a more exciting part of investing for retail now, because retail is starting to understand, okay, wow, you could, like, there's actually trading strategies that are built into systems and I could leverage that in my own portfolio. So they're starting to become, the awareness around this industry has grown very quickly over the last few years.
And since you touched on algorithmic trading, how could that potentially fit into a traditional portfolio? Of course, not financial advice, but just from your experience, because you have a traditional portfolio and you do use software.
Yeah.
How have you meshed the two?
Yeah, so I wouldn't say that I'm Mr. Traditional. I came from the traditional world in corporate, and then I was like, it just didn't align with my goals and ambitions for myself. So I am more of an alternatives guy. I've always liked alternative-based investments, so this very well clicks for me. Someone that's more traditional, which I know many people and many of the people that use our software are more traditional, right? They've got the S&P 500, they got real estate, they've got some bonds, and typically what you'll see, like prudent investors actually allocate it. And again, this varies very widely depending on their risk tolerance, goals, everything like that, and their income, and if they have dependents and a lot of things. But it usually varies between like 1 and like 20% of a portfolio, right? So if someone's like really advanced, they understand the software, they've got like high growth ambitions for their overall portfolio, maybe, and they've got a high income and they can take the risk because they're a little bit younger, maybe. We have quite a few people that have sold companies in their 30s, 40s that are using a higher allocation of their portfolio. They're actually selling off real estate and allocating more towards this alternative sector, you could call it, and that could be up to the 20% type mark. So, but usually, if you were to talk to like a financial advisor, it's usually like 1, 5, maybe 10% of a portfolio is in an alternative investments like this. Like algorithmic trading would be considered alternative. So I would say anywhere, if you were to talk to an advisor, it'd probably be between 1 and 10%.
So you mentioned that you haven't been a traditional guy. You've always been into alternative assets. What led you to build an alternative vehicle that could potentially be leveraged inside portfolios?
So, well, I guess what made me the most interested was the pain that I've gone through in bear markets. And specifically, I've like the main alternative that I focus on is like Bitcoin and crypto, right? I've run funds in that for years, and that's just been something I've been watching since college. Just 2013, like was when I first got into Bitcoin and bought my first Bitcoin. Didn't hold it the entire time. I'm not a Bitcoin
I don't think anyone
billionaire.
did, yeah.
But I've been watching the whole industry grow, and it's been super fun to watch it. And I do a ton of research, spend a lot of time looking at the industry, seeing different types of sectors pop up with inside of the overall industry, and it's a great industry to be in. But the problem is well, there's really twofold. One, I like to study the top people in whatever thing I'm trying to do. If I'm trying to play basketball, I want to study the best, Michael Jordan, LeBron James. If I want to study long-term investing and value investing, I'm probably going to study Warren Buffett. If I'm wanting to have higher upside and better returns, I'm probably going to study the most successful hedge fund manager of all time, which is Jim Simons. So what did he do since 1988 to 2018? He did 66% a year before fees running a quantitative fund. And he had 1 year where he lost money, which is probably where they were, well, technically before fees, they made 1%. After fees, they lost money, which is their second year in business. After that, they absolutely crushed it. They did over double-digit returns every year, sometimes triple-digit returns, such as in 2008, 2009, they did over 100% those years. But over a 30-year period of time, they averaged 66%, which blows everyone out of the water. Usually, like Warren Buffett, Stanley Druckenmiller, they're around like 30% averaging a year, which is spectacular, but not even close to 66%. So I like to study the most successful people in whatever thing I'm trying to do, and that happens to be Jim Simons and the Medallion Fund. And what did? They ran quantitative trading algorithms and built systems with some of the smartest mathematicians in the world. So first of all, understanding, okay, that's the most successful person, and what did he do? He talks about same type of theory with Warren Buffett is compound interest, the eighth wonder of the world. Let's just see how much we can consistently compound and try not to lose money. And that's what they did. They were able to compound for 30 plus years, and they're still running privately and crushing it. So yeah, number one, learning from them. Number two was, like I said, the pain from just bear markets in general, right? There's always bear markets. Even in 2022, we had the largest drawdown in US dollar terms across all assets, gold, bonds, stocks, crypto, everything went down. For me, as a focus on alternatives and in crypto, most of it came down 80%. And a lot of the exchanges like Celsius, Voyager, BlockFi, all those companies went bankrupt. So pretty much FTX half of the industry practically, if not more, went bankrupt
Yeah.
and destroyed a lot of portfolios. Thankfully, I didn't lose much of anything on those platforms, um, but but I still suffered, the year long of just this consistent sell off in the market. And I understand investing, and I understand that that's part of the game. So it's not like I sold the bottom. I held through, and I allocated properly, but still, it's tough to go through those types of markets. So I wanted something that could be consistent, which is market neutral strategies. And those strategies can bet on the long side and the short side. What you do is you have a cash account, the money sits in cash in the account. And then when the strategy finds opportunities, it enters the opportunity and it exits the opportunity. So you're never placing money into an investment and waiting for it to appreciate. This is a true, trading strategy, right? You can still be profitable even during some of the worst bear markets. And that's what I wanted. I also wanted something that could be a little bit more of a cash flow vehicle. And that's why, this can be a compounded vehicle that you consistently grow, or it's a cash flow vehicle. I like to use it as a cash flow vehicle at first, where I pull the profit out each month and I protect my principal, and I'll take the profit out, and then I'll go take the profit and I'll put it into like long-term investments. And then when I pull the principal out of that given account, then I will start to compound it. So yeah, those two reasons: studying the best person of all time in investments, and secondly, just the pain of bear markets. I'm like, dude, I need to find something that can, perform regardless of what. If Jerome Powell raises rates, it can still perform. Doesn't mean it's guaranteed to be profitable all the time. Nothing is. But it means that at least you have the opportunity to be, profitable and stay, consistent.
So instead of finding it, you built it. How did you build it?
Yeah, well, I mean, I'm not the actual developer myself, right? I'm a businessman that puts pieces together. So I build
Mm-hmm.
teams and recruit people, and yeah, so I find the best people in the industry that I can possibly find, put them together, put great minds together, and then there's a flow that we go through to design each individual strategy, and then ultimately put the portfolio of strategies together, and that's what we've found has created the highest risk-adjusted return. So I can walk you through like a study that we actually recently did on kind of everything that we're talking about right now, about how allocating a portion of a portfolio to something like this, like if it was a family office or a higher net worth individual, how adding a portion of a portfolio to these types of strategies, how that would impact the overall portfolio. Because if you know anything about finance and investing, what you're looking for is you're looking to decrease volatility and increase your return, right? So you're just looking for a higher risk-adjusted return. And you do that through adding things that are uncorrelated. So we ran a study from one of our strategies through our back testing, and it's super interesting to see how that would affect like a traditional portfolio.
And how would you be able to show that? Do you have a laptop or anything?
Yeah, so we've got one over here if you want to grab that real quick. One of our quants, Marcin, built this.
Let's see.
I took kind of exactly what I was talking about, which if you look at the overall study, we did a portfolio with a strategy, and we compared it to a portfolio without the strategy.
So this is going back to the point in the beginning of the video in which I referenced how could this fit into a traditional portfolio, right?
Yeah.
Because you're going to show it with and without using the software.
Exactly, yeah.
Over what period of time?
The last 10 years, January of 2015 to January of 2025.
Okay.
So in the benchmark portfolio, which is just like a typical portfolio, we allocated 50% to the S&P 500, 33% to Treasury bonds, which is the 7 and 10-year ETF. And then gold, we allocated 11% to. So I'll show you what that looks like in that return. Then what we did was we took those same assets, so the S&P, bonds, gold, we lowered those allocations. So S&P, the benchmark was at 56%, bonds 33%, gold 11%. Now the portfolio, which is the benchmark plus a market neutral strategy.
Your strategy, the one you built?
Yeah, the all weather. It's actually
all-weather.
the all weather that we've recently spoken about. We added that back test into this. Okay, so we put 50% in the S&P, we put 30% into bonds, we put 10% into gold, and we put 10% into the all-weather strategy, which is the portfolio strategy that we talked about called the all-weather.
Yeah.
Okay, so we took the back testing data from that all-weather strategy, which again is never 100% accurate. It doesn't predict future results, but it's the best way that we can look at, hey, how did this strategy historically perform? And then what we do is we run the live testing, forward testing on the strategy. We make sure that the metrics and the data from the forward testing that we're doing on live accounts is actually matching up to the statistics that we saw in the back test. And so far with our live testing, it has. So we have no reason to believe that the back test is incorrect. But and we do our best to not overfit, and that's also why we test over long, like 10 years. Some people will back test a strategy over 1 year, 2 years. Well, yeah, it performed really well during that type of market, but what happened when the market changed, when the administration changed, when interest rates changed, when inflation rates, So that can impact a lot of things, and that's why you want to run the strategies over long periods of time. So anyways, I'll kind of go through the statistics and show you what that looked like. So on the screen, what you're looking at is the chart, which shows the purple line is the portfolio with the market neutral strategy, the all-weather. The benchmark portfolio is the green line. So we started out with 100. So let's just say in this case, it's $100. And you can see that over that 10 period of time, the green line, the benchmark portfolio grew to 211.38 cents. The benchmark portfolio plus our strategy inside the portfolio grew to 403.74. So you'll see that if you were to look at the stats when you're comparing the different assets, and here's the important part. So we're looking at the average return. Equities had an average return of 11%. Bonds had 1.2%. Gold had 10.3%. Nurp strategy 70%. If you look at the combination of, or you go further into the statistics, what's important is volatility. So how did it affect the volatility of the portfolio? And how did it affect the risk-adjusted return of the portfolio? So we allocated, again, only 10% of the portfolio to this overall benchmark portfolio. And we rebalance it on a daily basis, because if you just let the things run, like anything that's outperforming the other strategies would grow to such a large portion of the portfolio, and we didn't want that to happen. We wanted the allocation to stay the same. So we rebalanced them on a daily basis. And you'll see that the volatility of the portfolio, of the benchmark portfolio, was 9.9%. Adding our strategy, the volatility went down, just 10% allocation went down to 8.7%. So from 9.9% to 8.7%, which is great. That's what you want. You want volatility in a portfolio to decrease when you're looking for proper portfolio allocation. The Sharpe ratio more than doubled. So the higher the number of the Sharpe ratio, the better the risk-adjusted return. The benchmark portfolio was a 0.79. The benchmark portfolio plus the market neutral strategy was 1.62. So it literally doubled the risk-adjusted return of the overall portfolio, which is spectacular. If we were to look at the other parts and just kind of summarize this, the annual return of the portfolio without the strategy, so just the benchmark portfolio, bonds, stocks, gold, that was a 7.8% annualized return. Adding the 10% into the market neutral strategy, over that period of time, it averaged 14.1%. So it didn't quite double the return, but it did substantially increase it.
Yeah.
And then you see, again, the portfolio volatility, we already talked about this, but it went from 9.9 to 8.7. So that's spectacular. For it to decrease volatility and substantially increase the overall average annual return, it's huge. It's exactly what you would look for when you're looking for portfolio construction, is when it decreases volatility, increases return. And then if you look at the reason why it can do that, and this is kind of the same thing with Bitcoin, Bitwise and a lot of other reputable banks and analysts have done studies on adding small pieces of Bitcoin to a portfolio over the last 5-10 years, and that does the same often. There's times where the correlation goes up to equities and goes down to equities, but overall, if you look at the studies, it decreases the volatility of the portfolio and increases the total net return, which is great. And that's why people are starting to allocate more towards Bitcoin. Maybe they're just simply buying the Bitcoin ETF. But the reason why it does that is because it's not highly correlated to the other assets. So if we look at the correlation matrix here, you'll see that our strategy has a 2% correlation to equities, which is practically nothing.
Nothing, yeah.
It has a negative 7% to bonds,
That's
which is
great, yeah.
practically nothing, and has a 0% correlation to gold,
Wow.
which is exactly what you're looking for. You're looking for, hey, how can I add, something to a portfolio that has strong amount of alpha, meaning it's outperforming, the index of whatever you're, primarily allocated to. And then you're looking for something that's uncorrelated to what you already have in your portfolio. And that's what, financial advisors and some of the best, long-term investment funds look for is uncorrelated assets that provide alpha, and they allocate a portion to it. So anyways, that's what really, in my opinion, these strategies are meant for, is like, the higher net worth person. Maybe it's a family office, maybe it's a higher net worth person that's got a couple $1 million that's allocated across different types of assets, and they're just looking to add a small piece of something else that can dramatically help the overall net return. But at the same time, if allocated properly and you're using proper portfolio allocation, it can also decrease the volatility and the overall risk of the portfolio.
If I had to ask you to answer this in just a couple sentences, what would be the North Star of this product?
Adding an uncorrelated piece in your portfolio that can help the overall net return increase. And that's what the value proposition of our products are. They provide that market neutral piece, which the majority of people do not have. It's very difficult to design market neutral strategies. And as long as you understand the strategy and as long as you manage the risk of the strategy, it can add a lot of value to a portfolio.
With building a product like this, I believe that a company is only as big as the CEO's vision. And you are the CEO of Nurp. Where do you see this product in the next 5 years? How far out can you see?
I think we're going to expand rapidly into the higher net worth market, because there's a lot of people that are like between 1 and 10 million. And they can't get into, like, when you're over 10 million of investable assets, you can get into places like Goldman Sachs, and then they open you up to, their deal flow, and you can get into different types of funds that have, low correlation to their assets, and they have market neutral strategies and a lot of different funds and things that you can invest in. But until you get to that point, you don't really have that much, and you're not, considered like an ECP, which is an entity or person that's worth over 10 million bucks. And after you're an ECP, you can then get into those like types of banks and products and things like that. So I think just being able to democratize this technology to, in my opinion, I think will be over 10,000 users in the next 5 years. And specifically in that, higher net worth market where they don't yet have access to these institutional grade type investment vehicles. But if they have, a financial professional in their life, maybe it's a small, family office like advisor, like a fractional family office advisor, or they have the desire to learn a bit about this and understand that this could be a super valuable piece of their portfolio. It does require a little bit of time to be able to understand it, to be able to see how it functions, to be able to decide where you want to set your risk parameters and things. But yeah, over the next 5 years, I think we'll easily attain 10,000 users, and we'll be in a place where we have a huge impact on that niche that I was speaking about.
So speaking of 10,000 users, how many people have already licensed these softwares from you?
Yeah, so we've had over 3,000. I don't think we've quite breached 4,000 yet.
Okay.
I think we're in the high threes, maybe 3,600 or something like that.
And if I heard correctly, this is kind of that limbo area where somebody is not past the 10 million necessarily, but they're in that 1 to 10 range. And this is helping them get to that next area of life.
Yeah, it's just helping them, get to the next level.
Yeah.
And like I said, like there's kind of this like weird intermediary place where people get to, maybe they sell a business for $3 million and they're not quite at the place where they can have like access to great, products and additions to their portfolio. So really just helping serve that type of niche is what we're focused on.
And since we're talking about all these people that you've allowed to license the software and the impact it's had, how much time are you allocating of your own personal resources and energy into building this?
A lot. I mean, yeah, a lot of time, because what I do in this company also helps our institutional side. So like everything that I'm working on here is like, the research and things that we do here impacts our institutional side. So I spend a ton of time. I mean, by default, it's a Saturday right now and we're working and I have a
Yeah.
meeting after this in 30 minutes. So we kind of got to hurry up. But by default, I am working, and then everything else just kind of fits into my life. So, if I'm going to the gym or I went to a friend's birthday party, like that's in between me working. So it's not like a, 9 to 5 job where it's like, all right, let's just do what we can and we'll check out for the day. That's not how I envision it. And I've spent millions of dollars employing people to help these strategies. I've even acquired IP as well, where we've said, oh, that's great IP that would be really valuable to our company. And we've bought the IP. So we spend, a significant amount of time and resources on this, because ultimately I'm building this for me. And I want to build long term, I want to build my own family office, and I want to be able to manage my own capital well. And I want, the highest risk adjusted return possible. So ultimately I'm building this for myself and to manage my wealth long term. And I am just building the product that I, again, wanted because of the pain that I've gone through with bear markets and things. And now I'm just focused on building this because I know that this is going to be, a long-term sustainable product and piece of my allocation that I allocate to long-term. So this isn't something that you build, like I've said in, the previous interview that we did, but this isn't something you just build one time and now you're retired on the beach. It's something that's always going to be optimized and improved. And it's going to be, it's a long-term project, but it's invaluable. It's probably the most valuable thing that I can spend my time and energy on, because if you can create a market neutral strategy like this that does perform even relatively close to what the Medallion Fund did, it's invaluable. Nothing is better than consistent compounding.
Yeah.
And ultimately, that's what I'm looking to do. So I am so excited to see the direction that we're heading with product, because I know how it's going to impact my overall portfolio long term and my goals that I have for myself. And whether that's, sometimes it could be me trying to cash flow. I'm even going to I've got another little startup that I've been thinking about for a while now, that's starting to come to the point where we're going to take the initial steps to begin that. It's a completely different industry. But what I'm going to do is, I don't typically raise money for any type of company that I'm starting. But I'm going to set up an account and I'm going to use the account to fund the startup. Having a cash flow, tens of thousands of dollars or maybe over 6 figures a month of income that you can put into a company to help grow the company, instead of raising outside VC capital. You can start companies and things that there's so many possibilities. It's not just I'm just shooting for 3% a month and that's it.
Yeah.
There's other things that you can do with something that can cash flow or can compound. And that's what I think is really exciting, is the possibilities are endless.
So you're going to use the software to potentially earn you some type of monthly income, and you're going to use that to go ahead and start another venture. That makes me want to ask you, how do you use the software?
Number one, I typically like to pull my principal out and protect it into long-term investments. So it's a piece of my portfolio. I'm primarily an investor. So I invest money and I wait for the thing to appreciate. But with a piece of it, I like to have a little bit more risk and have the ability to cash flow. But what I do is I typically pull out the profit until I collect my principal from the account. And then I will then compound that strategy and see how much I can grow it after that. So that's typically how I'm using it.
I've been using the software for 2 years. On this channel, I've documented loads of progress and journey of my own softwares. Mm-hmm. Something that's been thrown at me quite often is, if it's so good, why would you sell it? Mm-hmm. Why do you sell it?
First of all, the impact. I like seeing impact on other people, so that's number one. Number two is, like we've talked about before, you can create a large amount of enterprise value by having recurring revenue. So ultimately, you can create more enterprise value through a company by having a lot of recurring revenue quicker than you can even compounding like Jim Simons. And that's why some of the wealthiest people in the world are in VC and private equity. And almost every single billionaire has been created through private equity. And then the third piece is just the scale that we have in the market that we're in. So like we're in the FX market, the gold market, and starting to get into commodities, and now in digital asset market as well. So we see that expanding even potentially maybe into equities later down the line, but we haven't even spent any time there. But just within those markets, there is so much liquidity that even having someone trading the same strategy that I am, or thousands of people trading the same strategy, is not going to impact my overall return. So yeah, if it was going to diminish my return substantially, then yeah, it wouldn't make sense to be selling anything that would, impact the results that we're having. But that would take a huge amount of scale. I mean, billions of dollars to lower and diminish our type of return. So yeah, just the ability that we have scale, the fact that it creates more value for us and it also creates more value for other people, I think is really important. And that's why, we would consider even selling this. But like people think that it's only one or the other, right? I mean, you could say the same thing about Ray Dalio. Ray Dalio, if you're worth tens of billions of dollars, why would you raise money from other people?
Yeah.
It's like, because he can make more billions of dollars and he can also help those same people.
More people, yeah.
Why would Warren Buffett continue to take outside money? Well, because exactly what I just said. So you could say that about anyone that is managing money, any type of investment product. Why does Ferrari sell the car if it's such a great car?
Yeah.
Because they want to sell a great product to other people, right? So I think that argument isn't that great. I understand why they would think that way, right? And that's the reason why, we don't want to push our product onto anyone. We want people to come test the product. So if anyone's even watching this video, we'll just put the link below. You can test this product for $1.
Hold on. All right. So if I get a link and I put it in the description of this video that they're watching, you're going to give them the product to try out for $1.
Yeah. You can come, meet our team, talk to our member success team, get onboarded. You can set up a demo account or a live account. It's up to you, but we can get you a demo account same day. And you can see the strategy actually perform. And you can watch it for yourself before you even pay us anything more than $1. And if you're not willing to risk $1, then this is probably not right for you. But yeah, we don't want people that are not they don't understand what I just went through in this video, to be honest. I mean, what I just talked about is vitally important. We don't want people selling their dog and financing their grandma in order to put into an algorithm.
Yeah.
We want people to understand, I've got a portfolio. I want to portion off a piece to allocate to something like this, but let me just see how it performs. Let me see what this thing is about. And that's what we wanted to do. So yeah, I'll give you a link. They can get onboarded for $1 and they can just test it and see how it does.
All right. Well, that concludes everything. So you could get this entire product for $1 and try it out. Thank you for that. And thank you. I'm pretty sure the audience will thank you, and I'll see you on the next one.
Appreciate it.